If trading success was based only on analytical skill, then engineers, mathematicians, and finance graduates, every number-crunching whiz, would already be millionaires. But that's simply not the case. Most end up losing money in the market, just like everyone else. So what's the real issue? The problem isn't intelligence, it's behavior. That's the core of it all. On the surface, trading offers an abundance of data, statistics, models, and indicators. It looks like it's made for logical minds. Naturally, smart people walk in, confident in their own rational thinking. They promise to trust the process. They'll stick to the numbers, but fast forward 2 weeks and suddenly they're chasing losses, breaking their own rules, ramping up the risk. They're muttering to themselves, "I knew what I should have done, but I didn't do it." This cycle just goes on and on. Here's the uncomfortable truth. Most traders already have methods that could work. Yet, month after month, they still fall short. It's not about reading charts the best. The real difference between those who succeed and those who struggle is found far beyond analysis. Think about that. How many times have you mapped out a trade, nailed the forecast, and watched the market play out exactly as you predicted? Maybe you even shared that winning idea, told your friends, posted it on social media, and then saw the price move just as you said it would. But here's the twist. Did you actually profit from that spot-on prediction? For most traders, the answer is no. Maybe you hesitated, felt uncertain, and missed the entry. Or maybe you jumped in, got nervous, and cashed out too early, only to see the move play out perfectly without you. And sometimes, you do the exact opposite. You hold on, hoping for more upside, only to watch your gains disappear, your winners sliding into the red. This is the critical difference between being sharp with analysis and actually making a profit in the real world. Most people never bridge that gap. Let's look at a typical trading morning. You wake up, scan the charts, and spot a promising pattern. Your mind connects the dots. Everything lines up just like your analysis predicted. On paper, the risk-to-reward ratio is perfect, almost too good to ignore. The logic all makes sense, but just before you commit to that buy or sell, your thoughts suddenly start to spiral. Memories of a recent loss flash through your mind, the sting of being stopped out on a trade that looked just like this one. Financial worries start creeping in, whispering about the bills you still need to pay. Doubt surfaces. What if this setup isn't as clean as it seems? Maybe it would be safer to wait a little longer. Your finger hovers, ready to act, but you hesitate. Suddenly, you're overwhelmed by emotions and anxieties that have nothing to do with the chart in front of you. Or maybe you find the courage to execute the trade. For a split second, you feel proud, but as soon as the position opens, every tiny move against you feels like a punch to the gut. Your pulse quickens. You obsessively check your screen, glancing nervously every few moments. That carefully chosen take-profit target. Suddenly, it feels miles away. Anxiety creeps in, and you find yourself mentally pleading, bargaining, and second-guessing the plan you trusted just minutes ago. Maybe you start thinking about moving your take-profit closer, hoping for a bit more safety. Or perhaps you consider closing out right now, taking a modest win, instead of risking it turning into a loss. But here's the intriguing part. None of these reactions are grounded in your understanding of the markets. The technicals haven't changed. Fundamentals remain the same. The trade setup, the very reason you entered, still stands. The only thing that's changed is what's happening inside your mind. This gets to the heart of why trading is a behavioral challenge, not just an analytical one. You could spend thousands of hours mastering chart patterns and learning market theory. But if you can't control your emotions and impulses, all that expertise means nothing. You'll fall into the same old traps, making decisions that go against your own logic, sabotaging yourself again and again. Take Marcus, for example. No one ever questioned his analytical brilliance. He could spot patterns on a chart that most people would completely miss. His understanding of market dynamics was truly impressive. Other traders often turned to him for advice, and most of the time, his market calls were right on target. But Marcus still couldn't turn that skill into profits when trading for himself. In fact, his account balance was shrinking, trade after trade. So what was causing this disconnect? Did his technical skills suddenly fail when real money was involved? Not at all. The charts hadn't changed. The setups were still there. What changed was that his own money was at risk, and that brought out a whole new psychological challenge. When Marcus reviewed trades for others, he stayed clear-headed and methodical. With no personal risk, he could calmly follow his systems. But once his own money was at stake, everything changed. Suddenly, every fear about the future, worries over bills, security, and success started to cloud his judgment. The discipline vanished. His emotions took over, drowning out his careful analysis, and he began making choices that went against all his expertise. This constant battle between what we know and how we behave can be truly punishing. Marcus knew exactly what was happening to him. He was keenly aware of the cycle, letting fear, instead of logic, drive his trades. He would bail out of winning positions too early because the anxiety became unbearable and hang on to losing trades, unable to face the discomfort of admitting defeat. He could see his mistakes as they happened and understood why they occurred. But having that self-awareness didn't give him control, and this is where almost every trader falls short. There's a common belief that simply recognizing our behavioral pitfalls is enough to fix them, that if we see the trap, we won't fall in. But the truth is, awareness is just the first step, and it's actually the easiest one. The real test comes when you have to retrain your instincts in high-pressure situations, when the market is moving fast and your nerves are pushed to the edge. So why do our actions often go against the analysis we've worked so hard on? Here's something most people overlook: the human brain wasn't designed for trading. It's an important point, so let me say it again. Evolution didn't prepare us for the world of markets and trading floors. Our brains developed to help us survive in a world of immediate physical threats, hungry predators, sudden dangers, and quick chances to stay alive. The rule was simple: spot danger, react without delay, find food, eat quickly. Those who paused to analyze rarely survived long enough to pass on their genes. But trading turns this instinct upside down. The market asks you to risk your capital, sometimes again and again, even after setbacks. It demands a level head and steady discipline, even when you've faced repeated losses. You're called on to stay calm and rational, even while your deepest instincts sound the alarm. Patience becomes crucial, even though your natural urge is to act right now, do something, anything. Pay attention to what happens inside you after a losing trade. Your pulse races, adrenaline floods in. The part of your brain that processes physical pain lights up just as if you'd been hurt. To your mind, seeing red in your account feels almost the same as facing a real threat. The fight-or-flight reflex kicks in, pushing you straight into survival mode. In these moments of threat, logical thinking steps aside, and automatic reactions take over. This drive is what fuels revenge trading. After a loss, your mind doesn't just see a setback, it takes it personally, as if you've been attacked. Your instinct is to retaliate, to reclaim what you feel was unfairly taken. You want to fight the market, to prove yourself, and recover your losses. But you forget the market isn't your rival. It has no intentions. It's indifferent. Yet your emotional brain doesn't see it that way. It just wants to get even. Oddly enough, winning can be just as dangerous. After a run of victories, confidence surges. Suddenly, you feel unstoppable. You start increasing your position sizes and let your discipline slip, convinced that your hot streak will last forever. This is the classic trap known as recency bias. Your most recent experiences cloud your judgment. For traders, this can lead straight to reckless, self-defeating decisions. Consider this familiar pattern. A trader sticks to their strategy, day after day, steadily building small profits through disciplined trading. Then, suddenly, a streak of big wins, a few quick successes arrives. Confidence surges. In an instant, a couple of rash trades erase weeks of careful progress. The skill for analysis is still there, but the behavior slips. Here's another perspective. Have you ever noticed yourself making very different decisions depending on the time of day? Maybe you're focused and methodical in the morning, but by late afternoon, you find yourself chasing setups you know you should avoid. What changed? The market conditions haven't magically changed. The patterns are still the same. What's changed is inside you. This shift is called decision fatigue. Every decision you make throughout the day uses up your mental energy, and that makes it harder to control your impulses. Think about it. After a morning filled with choices like what to eat for breakfast, which shirt to wear, which emails to answer, and what to say in meetings, your mental reserves start to run low. Each micro-decision depletes your pool of discipline. So by the afternoon, your willpower is worn out. That's when impulsive trades begin to creep in. You start breaking your own rules, not because you don't know better, but simply because your mind is too tired to stick to them. The pros know this challenge all too well. Experienced traders often work the markets only during specific hours, or limit how many trades they make each day. It's not about restricting their opportunities, it's about keeping their minds sharp. They understand their edge isn't just in better analysis, it's in consistently following their plan, and that kind of consistency requires a lot of mental energy. Now, here's where things get even more fascinating. Imagine two traders, both using exactly the same strategy, the same tools, and following the same rulebook. On the surface, everything seems identical, yet one ends up with profits, while the other racks up losses. How can that be when both use the exact same analytical formula? It all comes down to how those rules are put into practice. The trader who consistently cashes in sticks to the system. They enter every trade signal that appears, let their winners run all the way to the target, and take losses quickly when needed. Most importantly, they resist the urge to make decisions based on gut feelings. On the other side, the losing trader only picks signals that feel comfortable. When nerves take over, they cut their gains short. They hold on to losing trades, hoping for a miracle comeback. Even worse, after a winning streak, they increase their position size, then play it safe, and go small after a loss. This is the opposite of smart risk management. Two traders might use the same strategy, yet end up with wildly different results. The difference? Human behavior. And that's why paper trading, or using a simulator, rarely leads to real improvement when it comes to trading for real. Simulators are useful for getting to know a platform's features, or seeing if a strategy might work in theory, but they don't show you how you'll really behave when your own money is on the line. In a simulated setting, emotions like fear, greed, or ego don't come into play. You're simply clicking buttons, with no real consequences. That means you're skipping the hardest part of trading, not figuring out what to do, but actually following through when it matters most. Here's something important to keep in mind about the gap between theory and practice. Some traders manage to earn steady profits using the simplest of systems, maybe just a moving average crossover or basic support and resistance levels. Meanwhile, others rely on complex setups, analyzing multiple time frames, using advanced indicators, and digging into layers of fundamental research, yet still, their accounts can shrink. How can that be? Intuitively, you might think deeper analysis always wins, but that isn't always the case. The trader with the simple method often comes out ahead. They've uncovered the real secret: behavioral consistency. Their strength isn't in having a complicated system, but in their steady commitment to what works. With an ultra-simple strategy, there's no room for interpretation. Its clear-cut actions are black and white. There's no chance to bend the rules or talk themselves into going off script. They just execute the plan again and again, and over time, their statistical edge has a chance to show itself. In contrast, the more advanced trader, buried under layers of analysis and countless variables, always faces uncertainty. This uncertainty creates a built-in excuse to hesitate or override the plan. All that complexity can become a trap. The more options you have, the easier it is for emotions to slip in and steer your decisions off course, giving you endless justifications for poor choices. Pause a moment and let that sink in sometimes. More knowledge and deeper analysis can actually lead to worse outcomes. That says a lot about what really separates winners from losers in trading. Now, let's clear up a common misconception. When people hear the term trading psychology, they often think it means eliminating emotion, becoming a cold, calculating machine. But that's not what this is about. No one can simply switch off their feelings, and honestly, you shouldn't want to. Emotions aren't your enemy in the market. They're signals. Fear can alert you to real dangers, while a surge of excitement might warn you about growing overconfidence. The real challenge isn't to shut down these feelings, it's to make sure they don't take control of your decision-making. The real difference between traders who succeed and those who struggle isn't that successful traders never feel emotion. It's that they know how to handle their emotions when it matters most. Profitable traders recognize feelings like fear, greed, doubt, or excitement, but they still follow their plan. They've learned to create a little space, a brief pause, between the moment they feel something and the moment they react. In that tiny gap, true discipline takes root. And in trading, discipline is the heartbeat of long-term success. Searching for a real edge, it's not hidden in secret indicators, exclusive information, or some mysterious trading system. The real advantage comes down to this: doing what needs to be done, exactly when it needs to be done, no matter what your instincts are telling you. Think about it. Do you stick to your stop loss, even when your mind insists the market is about to turn around? Do you follow your position sizing plan after a winning streak, resisting the impulse to take on more risk just because you're feeling invincible? And can you be patient enough to stay out of the market when there are no good setups, even though boredom might tempt you to trade just for the thrill of it? Are you able to trust your system and take the next signal, even after 3 losing trades in a row? This isn't about analysis, it's about behavior, and it's incredibly hard. Think of it this way. Your analytical skills show you what you should do, but your behavior decides whether you'll actually do it. You might know market theory inside and out, but if your discipline slips, your trading results will show it. The market doesn't measure how much you know it, only cares about what you actually do. What makes this even trickier is that lapses in discipline often hide in plain sight. Picture this: you exit a trade too soon because fear takes over. The market moves right to your original target anyway. Sure, you made a profit, and losing doesn't hurt this time, so you just shrug it off. But here's the truth: you've just reinforced a habit that, over time, can strip away any edge your strategy once had. Trading isn't about a single win or loss. It's a numbers game, played out over hundreds, even thousands of trades. If you get used to cashing out early, you quietly sabotage your long-term gains and weaken the 19 reward part of your risk-to-reward ratio. If you let losing trades run, hoping they'll turn around, your risk grows. Over time, little mistakes like these can take a strong trading system and turn it into a losing one. Most people don't notice this happening until the losses become severe. That's why you hear stories of traders who seemed reliable for months, but then lost everything overnight. Their analytical skills didn't disappear. Instead, their self-discipline slipped away, slowly eroding their foundation until, one day, the damage exploded. Maybe they chased bigger wins, or slowly started ignoring their own rules. Whatever the cause, those small mistakes added up, and eventually the strategy fell apart. Small behavioral slips over time can lead to disaster. So, let's shift our focus to a real example. Let's look at how preparation shapes behavior. Again and again, I see that traders who struggle psychologically almost always lack a strong preparation routine. Some don't prepare at all. They arrive and jump straight into trading. What happens then? They end up reacting to every move the market throws at them, getting tossed around by uncertainty. When you trade reactively, your emotions take the wheel. Now think about traders who focus on thorough preparation. Before the opening bell ever rings, they've already chosen their setups, mapped out their entry and exit points, set clear risk limits, and walked through possible scenarios in their minds. These traders aren't making things up as they go. They're ready. Preparation changes everything. It takes emotion out of trading, because the hardest decisions are made calmly, away from all the chaos. So instead of scrambling under pressure, prepared traders simply follow their plan. This approach gives you a significant advantage when it comes to self-control and consistency. But here's the twist: even preparing properly requires discipline. In fact, preparation is more than just an analytical task. It's a behavioral challenge in itself. At the heart of trading success in every way lies behavior. And there's an uncomfortable truth that many avoid facing sometimes. The real reason behind your struggles with behavior is that you're risking money you can't afford to lose. When your trading account contains money set aside for rent, groceries, or your family's needs, no level of technical skill or market knowledge can protect your mindset. The stress of risking essential funds will overpower your analysis and overwhelm your strategy. That's why the old advice, "only trade with money you can afford to lose," is more than just a financial tip. It's crucial behavioral guidance. If losing money would deeply impact your life, it's impossible to stay calm and detached. Every loss will feel like a crisis because in many ways it truly is. You might have flawless market analysis, but if you're trading out of fear, your behavior will fall apart. Professional traders understand this at their core. For them, sizing a position isn't just about limiting losses, it's also about protecting their state of mind. If you risk so much that you end up losing sleep, you've already hurt your chances. In that state, fear starts to make decisions for you. The right position size is the one that lets you follow your trading plan without anxiety clouding your judgment. In the end, it all comes down to behavior, not theory or charts. The most brilliant insight means nothing if you're overwhelmed by stress or risking your rent money. In times like that, your own behavior will always betray your strategy. Here's another way to think about it. Think about the traders you respect, the ones who generate profits, not just for a month, but year after year. What sets them apart? It all comes down to one key trait: unwavering behavioral discipline. Every one of those consistent traders found a method that matches how they see the markets and then committed to mastering their own behavior around it. Some hold trades for weeks, others just minutes. Some people pore over charts, others sift through balance sheets. Many do a bit of both. When it comes to analysis, everyone's approach is different. But when it comes to discipline, They're almost all the same. They stick relentlessly to their chosen process. That alone shows where the real work is. Forget about chasing some mythical perfect setup. It simply doesn't exist. What truly matters is building the emotional and mental strength to carry out your plan every time without letting nerves or excitement throw you off track. Here's a tough truth that many people overlook. Most traders pour nearly all their energy into analysis, but spend very little time on behavioral training. Then, they're surprised when the profits don't come. These priorities are backwards. Once you have a real trading edge, whatever your approach, what matters most is how consistently you follow it. In the end, what separates you from steady profits isn't your ability to crunch numbers or predict price movements, it's your actions, especially in the heat of the moment. Your research might show that a trade has a strong 70% chance of working out, with a solid risk-to-reward setup, but the real test isn't in the analysis, it's in what you do next. Will you actually pull the trigger? Can you let your winners run as planned, or will you bail out too soon? Will you honor your stop if the trade turns against you? And after a loss, will you size your next position correctly and stick to your process? Every one of these choices comes down to your behavior, not your charts. That's why your potential as a trader depends on what you can control your own actions. The market is wild and unpredictable, but your approach and your discipline are always in your hands. If you're searching for obstacles to your success, don't look outward. The biggest challenges are within yourself. You have the power to change these, but only once you admit they exist. Being the sharpest analyst in the room means little if you haven't mastered your impulses. To truly thrive as a trader, you need to commit to shaping your behavior. That's the essential lesson. Next time you face a loss, miss an opportunity, or make a mistake, don't rush to chase a new strategy or fancy tool. Instead, pause and ask yourself, was this a failure in analysis, or was it a behavioral one? Ask yourself, did I truly not know what to do, or did I just not act on what I already knew? Most of the time, the answer is simple, it's about behavior. When you start to see this pattern, when you realize that your own habits and reactions are holding you back, everything starts to change. Instead of looking for solutions outside yourself, you turn inward. You start to tackle the real obstacles. Here's the heart of the matter. Trading is actually straightforward. The mechanics reading a chart or spotting a trend aren't a mystery. Almost anyone can learn those skills. But mastering your own behavior, resisting temptations, and managing stress, now, that's where the real challenge begins. The true battleground is learning to navigate your emotions, stick to your plan, and deliver consistent execution. It's about weathering losses and staying humble, even after a winning streak. That is the real test. If you don't truly accept that trading demands more from your behavior than your intellect, if you keep chasing new systems instead of refining how you execute, frustration will always find its way back to you. You'll keep wondering why all your market knowledge doesn't translate into real profits. The truth is, the market doesn't care what's on your mind. It only